Okay, let's welcome on board a guest from S&P Global Ratings as well. Andrew Wood is joining us to talk to us about how the potential for India is there for a re-rating perhaps. Andrew, hi, thank you so much for making time and speaking with us. First up, tell us what are the key parameters that has been an impediment for India to actually get re-rated, because if I understand it right, we have been stuck at that triple B minus for the longest time now when it comes to the global ratings. What's your sense?
Sure. Thanks very much for having me. Look, I think that India's ratings are balanced essentially between very healthy and strong growth prospects that are consistent over the years on a trend basis too, and a strong external position, or you could say a strong external balance sheet, weighed against the very weak fiscal performance of the government. That's characterized by high fiscal deficits, general government deficits on an annual basis. This year we forecast that just above 10% of GDP, and a high debt stock at the general government level as well. We see that as being around 87% of GDP on a net basis. So, I think in balance, what we come to is a triple B minus rating here with a stable outlook.
Okay, and is there a case you think that the macros have changed, something has turned for the better for you to relook at it? Or do you think there has been nothing material in terms of the changes, in terms of the fiscal deficit, etc., that you pointed out to make you change your ratings?
I think when we take a step back and look at the landscape right now, certainly things are challenging on the external front, right? So that means that India is going to be running a higher current account deficit this year. There's a little bit of pressure on the rupee at the moment as well. And there's some inflationary pressure, certainly globally and also in the domestic economy in India. So we'll be keeping a close eye on these factors. We do expect growth to be pretty strong going forward still. We see the economy growing at a rate of 7.3% this year, and then over the next few years, staying above 6.5% on a real basis per year. So that's good news. But what we would need to see over time to put more upward pressure on the ratings would certainly be more powerful, more expeditious fiscal consolidation. So consolidation of that general government deficit, as well as the debt stock beginning to come down materially compared to the size of the economy. So for it to fall relative to GDP, and also for the interest burden of the government, that's around 27% of total revenue on an annual basis, for that to come down significantly as well.
So, Andrew, what's the median in terms of, as you pointed out, the debt to GDP or the interest cover to revenue, etc.? What are those metrics and the mediums that you had to look for, and how far away is India in that?
Sure. So when we look at the debt stock, for instance, the weaker threshold that India is meeting currently is 80% of GDP on a net basis. Again, the debt stock is larger than that at the moment. We forecast it to remain larger than that for a number of years beyond 2022. The interest burden of the government, again, at more than 25% of revenues per year, that's well above our weaker threshold, which is indeed 15%. So there would be a lot of progress probably that we would be looking for on that front too. If we compare India to emerging market economies, a debt stock of close to 90% of GDP on net basis certainly is in the weaker group. At the same time, that interest burden is flagging to us that the efficiency of the fiscal program could be tighter, right? Because you are spending a significant proportion of your revenues on debt service every year, rather than on social services or capital expenditure.
Right. How does all of these numbers change when you suddenly start to see Capex picking up? You start to see a lot of positivity. A lot of big groups have done a lot of M&As. They have announced a lot of, Capex going ahead across businesses that they have. So when you see such sort of Capex coming in, how does this entire thing of servicing more debt, government has to push the Capex, how does it change?
Sure. So I think we're pretty constructive, in fact, on the Capex cycle in India right now. And that goes for both the public sector Capex as well as private sector Capex. These trends that you're discussing here, we do see those supporting economic growth and productivity growth over the next few years. At the same time, we're seeing Capex as a proportion of the general government budget, certainly of the central government budget, growing, which means that the quality at the margin of the central government budget is getting better on an annual basis too. So that's good news. I think, however, again, if I point back to these fiscal indicators and debt indicators that we look at very closely for India, it will take some time for those to improve materially such that we're looking at much stronger numbers or levels that might, start to feed into upward pressure on the ratings.
Andrew, is there a case to be made that you'll have to shift your median itself? Now, given the macro headwinds that we are seeing across the globe, on a relative basis, you do have to acknowledge that India is doing a bit better than what at least is happening in the West, whether it's the UK or the European geographies, etc. And given the entire slowdown in the world, is there a case to be made that the median itself will have to be re-rated downwards, given the context?
Sure. So I think that, another important metric that we look at on our ratings is the state of the economy. Again, I mentioned the strong growth prospects in India, especially over the next few years. But we look at GDP per capita too. This gives us a good idea in terms of the level of development of the economy, the productivity, and the wealth that the government is able to draw upon in order to service its obligations, right? And for India's GDP per capita, that's going to be a very key differentiator in the ratings construct if we're comparing to Western European ratings, typically speaking, the sovereigns there, as well as in North America. So that really remains the case. In terms of the debt numbers themselves, well, these are all relative to GDP to begin with, but at the same time, I want to make clear that these are absolute levels, okay? So we do not compare, for instance, to a median in the same ratings class, but we compare on an absolute level. We see that that stock in India certainly is among the higher ratios that we see around the world, either for an emerging market or for a developed market.
Just as we are speaking, rupee is close to 82 to a dollar. Dollar index is at 114.4. What do you make of the havoc that's happening across currencies?
Sure. So absolutely, we're seeing a lot of pressure through the currency channel across the region right now. And India is not immune to this totally, right? So we're seeing downward pressure against the rupee. We're seeing, again, what I mentioned earlier, that higher current account deficit in India this year, which could approach 3% of GDP. However, as mentioned too, the external balance sheet in India is quite strong from our perspective. So right now we see India as a modest net external creditor to the world. And we also note that the government does not have essentially foreign currency denominated debt. So they're able to fund themselves entirely in local currency markets. Also, when the currency weakens, that means that the debt stock is not going to rise significantly relative to GDP, because you're not having that currency exchange effect. So that's good news. And what it means is that this strong external position of the Indian economy that we've been noting for a long time and factoring into the ratings remains in for longer, or let's say it's a little bit deeper than we're forecasting or expecting right now. India could become a modest net external debtor economy again, but we don't see that as a major challenge or risk to the ratings at the moment.
All right. Thank you so much, sir, for taking out time for us, telling us about what you make of the Indian economy. Is there a case for upgrade or not, or what are the things that one should watch out for going ahead in the economy? Thank you so much for that. Let's now focus